Have you ever wondered what index investing is? Well, slide back into that cozy armchair of yours because you're about to find out. Index investing at its core is a type of investment strategy that mirrors the performance of a specific market index. Think of it like a mirror reflecting a bustling city skyline. That's your market index, such as the S&P 500. Now imagine you own a miniature model of that skyline, with each building representing a different company. That's your index fund. In other words, when you invest in an index, you're basically buying a tiny piece of every company listed in that index, in the exact same proportions as they exist in the index itself. It's a passive form of investing, meaning you're not out there hand-picking individual stocks. Instead, you're placing your trust in the overall performance of the market. So that's index investing in a nutshell. But why would anyone choose this approach? There are several reasons why investors might choose index investing. First and foremost, it provides broad market exposure. This means you're spreading your bets across hundreds or even thousands of different stocks or bonds, which can help to mitigate risk. Next, index funds typically have lower operating expenses than actively managed funds. This is because they simply aim to replicate the performance of an index rather than trying to outperform it, which can require costly research and trading. Additionally, index funds tend to have lower portfolio turnover. This means they trade less frequently, which can result in fewer taxable events and lower transaction costs. Finally, studies have shown that over the long term, index investing can offer better risk-adjusted returns compared to active investing. This is because it's not about trying to beat the market, but rather matching its performance. Sounds pretty good, right? But like any investment strategy, index investing also has its downsides. While index investing has its benefits, it's not without its drawbacks. One of the most commonly cited disadvantages is the lack of control over your portfolio. When you invest in an index fund, you're effectively handing over the reins to the fund manager, who decides which stocks to buy and sell. Secondly, index investing inherently limits your potential for outsized gains. Since these funds are designed to match the performance of the market, they're unlikely to significantly outperform it. So if you're looking to beat the market, index investing may not be your best bet. Thirdly, there's the risk of index tracking errors. These occur when the fund fails to accurately replicate the performance of the underlying index. And let's not forget, index investing means you're fully exposed to market downturns. When the market tanks, so does your portfolio. So, index investing isn't a surefire road to riches, but is it worth considering? Despite its pros and cons, index investing can be a valuable part of a balanced portfolio. Let's take a moment to reiterate the key points about index investing. This strategy provides broad market exposure, allowing investors to ride the wave of the overall economy. It's also an avenue for potentially lower costs, as it skips the fees associated with active management. However, it's not all sunshine and roses. Index investing does mean surrendering some control, as you're buying into a preset basket of stocks or bonds. And of course, there's the inherent market risk. When the market dips, so does your investment. But here's where it gets interesting. Consistent investment in an index like the S&P 500 has shown to build wealth over time, riding out the market's ups and downs. It's a testament to the old adage, time in the market beats timing the market. In the end, whether index investing is right for you depends on your individual financial goals and risk tolerance. But now, you're equipped with the knowledge to make that decision.